government. But while the move may calm the markets, what does it mean for America's financial system? More specifically, what does it mean for you and me in terms of our mortgages? Joining us from Nashville this morning is the author of Mortgage Cocktails, Steve Curnutte, is the president of Ends Bank Mortgage, and in Oakland, California, is mortgage and housing independent research analyst Mark Hansen, also known as Mr. Mortgage. Good morning, gentlemen. Thanks for joining me.
Good morning.
Appreciate being here. Thanks, Alexis.
Wow. Mark, Mr. Mortgage. All right, I'm going right to you. What exactly does this mean for homeowners, either those who can right now hold a mortgage or someone who intends to go out there and purchase a home, refinance? Explain it to me.
Well, for all intents and purposes, nothing has changed from last week. I mean, Fannie and Freddie Mac still exist. They're still guaranteeing home loans. And nothing has changed. But, you know, that didn't look like that on Friday. As a matter of fact, this $300 billion line at the U.S. Treasury was crucial in supporting the Fannie Mae and Freddie Mac mortgage-backed security market, but placing that potential problem onto the taxpayer if anything should go down with regards to higher default rates or loans going bad and payments being made to bondholders.
All right, Mark, clarify this for me, because there was a good article in the Sunday New York Times yesterday talking about what the implications could be, or what's been happening people who are trying to get out there and refinance their mortgages or look for alternatives. Isn't there some risk if Fannie Mae and Freddie Mac cannot raise capital as aggressively as they like, or the yields on their bonds rise, that in fact yields on, or the rates that we borrow for a 30-year mortgage may rise as well?
Oh, right. I mean, in the last couple of weeks, you've seen spreads widening. That's the market pricing and risk inherent with mortgage-backed debt. Fannie Mae says they have $350 billion in Alt-A loans on their books, $50 billion in subprime. Freddie Mac a little bit less. Call it $700 billion in total. We know by private sector Alt-A and subprime loans what the default rates are. Here in California, the subprime problem is plateauing, and Alt-A and prime loans are starting to see a surge in defaults. So there's risk inherent with all real estate transactions. For far too long, perhaps, agency mortgage-backed securities, which are mistakenly thought of as safe as a U.S. Treasury,
right,
have been perhaps priced too low. I mean, the market has to figure that out.
Okay.
And that's why they came and put the $300 billion backing on it, because we can't have that market fail, or they're not going to be able to produce new loans on the front side. So for all intents and purposes, we avoided a calamity here.
All right, so Steve, in essence, the way I look at it is it's hard to find money right now in general. Many of the major banks are not lending as aggressively as they were before. The credit requirements are rising aggressively. If you're at home right now, or if you're someone who's nearing retirement, what are the bigger implications? I know one of them is reverse mortgages. Talk to me about that.
Well, you're exactly right. There are two things happening here. First, with the death of the securitization market, and of course, IndyMac, it was dead long before IndyMac failed on Friday. Really, Fannie and Freddie now make up 80% of this lending market on the conventional side. So their behavior makes a huge difference on just getting a loan. So if you're sitting at home getting a loan right now, you're thinking about two things. You're thinking about pricing, you're thinking about underwriting. So you got to divide those conversations and talk about them separately. First, with pricing, it's exactly like what Mark was just saying, that 5 years ago, Freddie Mac and Fannie Mae were able to borrow at about 43 basis points above the 10-year Treasury yield. And the rest of the market was having to borrow at about, I think it was around 120, 119, something like that. And as of today, Freddie Mac and Fannie Mae, it costs them about 102 basis points above the 10-year Treasury yield. That's the pricing end of risk that Mark was describing. So the first thing you've got to know is that your rates are going to be a little bit higher because of this. Even though Paulson's plan from Sunday is helping the market some, restoring some confidence, there's still going to be an issue here with pricing. So that 30-year fixed mortgages should be where the 10-year Treasury is now. They should be around 5.875, 6%, something like that. And instead, they're going to be a quarter point or more higher. The second thing you got to think about is underwriting, and that's the big problem right now. And that steps into the issue of reverse mortgages. With underwriting right now, it's just getting tougher generally. And Freddie Mac and Fannie Mae have to be more conservative with the loans they're making. They've been spending like drunken sailors for the last decade, and it's got to stop.
Right.
And so it's more difficult to get a loan. And particularly with condo loans, we're seeing mortgage insurance providers pulling back and saying on condos we're not going to provide mortgage insurance above 90%. So this affects a lot of areas of the country. Now Innsbank is based in the southeast, so we've got some areas with a lot of urban condo development. It won't affect us quite as much, and a lot of baby boomers, of course, are going to condos, but they typically have down payments.
Okay.
The big issue here is the discussion of reverse mortgages, right?
Yeah.
No underwriting. No income documentation, no asset documentation, and since the gigantic sales machine of the mortgage business can no longer, loan to subprime folks, and they can't eat their young, they're going to have to sell to old people. Reverse mortgages, I think, in some circumstances can be good, and we have to delineate those.
Okay.
But in a lot of circumstances, they're not good.
All right, Mark, quickly, you only have about 10 seconds here. Do you think this changes the mechanics of the mortgage market?
No, as housing underpins everything. And as long as we have trouble in housing, which in California,